say thank you for coming in our lesson today. It's great to see you all. Let me introduce myself. My name is Salsabila Noviana Putri, and this is occasion we will talk about equity securities. Let's check it out. What is an equity securities? An equity security is a financial instrument that represents an ownership share in a corporation. The instrument also gives its holder the right to a proportion of the earnings of the issuing organization. The typical equity security is common stock, which also gives its owner the right to a share of the residual value of the issuing entity in the event of liquidation. A less common equity security is preferred stock, which may also provide its owner with a periodic dividend along with other rights that give it priority interest over the holders of common stock. A variation on the equity security concept is the stock option and the warrant. Both instruments give their holders the right, but not the obligation, to acquire share in a corporation at a certain price and over a predetermined period of time. Equity security also give their holders varying level of voting rights in regards to certain matters, such as the appointment of a board of directors that then act on behalf of the shareholders. A sufficiently large amount of ownership of equity securities will give the owner voting control over a business. Depending on the restriction not on the face or back of a stock certificate, it may be possible to sell shares to a third party. Only corporations issue equity securities. They are not issued by non-profit entities, partnerships, or sole proprietorship. Investments in stock. A company may invest in the stock of other corporations if it has no immediate need for its cash. A separate account mentions the unique name of the corporation for each stock investment is used. For example, a company might invest in the stock of 3 other corporations and use investment in ABC stock, investment in Home Depot stock, and investment in Delta Airlines stock as their 3 distinct asset account names. On the balance sheet, these individual investment accounts may be combined in the marketable securities listing for short-term investment and or the equity securities listing for long-term investments for an efficient presentation. Possible journal entries. There are 5 possible journal entries related to investing in stock as follows. First, purchase the stock investment. Second, receive dividend payments. Third, recognize net income of the issuing corporation. Fourth, adjust to fair value. And the last, sell the stock investment. Each stock investment is accounted for using one of 2 methods, either the fair value through net income method or the equity method. The choice for each investment depends on the percentage of another corporation outstanding shares that the investing company purchased. If a company purchased less than 20% of another corporation outstanding shares, the fair value through net income method is used. Investors who own less than 20% of the outstanding shares are not considered to have significant influence over the company they are investing in. An example would be the purchase of 1,000 shares of another corporation that has 100,000 shares outstanding. The investors owns only 1% or 1,000 or 100,000. If a company purchases between 20% and 50% of another corporation outstanding shares, the equity method is used. Investors who own between 20% and 50% of the outstanding shares are considered to have significant influence over the company they are investing in. An example would be the purchase of 40,000 shares of another corporation that has 100,000 shares outstanding. The investor owns 40% or 40,000 or 100,000. The purchase of more than 50% of another corporation outstanding share is considered a consolidation and will not be discussed. Two versions of the 5 journal entries related to investing in stock are illustrated by side by side in the journal entries that follow. The transaction on the left illustration the fair value through net income method, where the investor owns 10% or less than 20% of the outstanding shares. Those on the right show the equity method, where the investors own 25% or more than 20% of the outstanding shares. Explanations are included. 1. Purchase the stock investment. There is no difference between the fair value through net income and equity methods when stock is purchased. The accounts used in the journal entries are identical under both methods. The first method is fair value through net income method. Investment in ABC stock is an asset account that is increasing. Cash is an asset account that is decreasing. Second method is equity method. Investment is an ABC stock is an asset account that is increasing. Cash is an asset account that is decreasing. 2. Receive dividends payments. One difference between the fair value through net income and equity methods is seen when the issuing corporation pays cash dividends. First, fair value through net income method. Under the fair value through net income method, the investor simply reports dividends received as revenue. The dividends revenue account is credited. Second, equity method. Under the equity method, dividends received are reported as a reduction of the investment account. The investing company's significant ownership percentage result in a transaction that is analogous to the corporation paying itself. 3. Recognize net income of the issuing corporation. Another difference between the fair value through net income and equity method is seen when the issuing corporation reports net income. First, fair value through net income method. There is no journal entry under the fair value through net income method, where the percentage of investor ownership is not considered significant enough to participate in the issuing company's earnings. Second, equity method. Under the equity method, the investing corporation owns such a significant percentage of the issuing corporation's share that is actually takes ownership of its percentage of the issuing corporation's net income and reports it as its own. 4. Adjust to fair value. First, Fair value through net income method. A third difference between the two methods is that the carrying value of the investment under the fair value through net income method must be adjusted to fair value at the end of each accounting period. Fair value is the current trading price of the stock on the market, which is readily available for public corporation in financial newspapers and online sites. For investment that involve less than 20% of the issuing corporation's outstanding stock, a gain or loss is recorded if fair value is different than carrying value. However, it is an unrealized gain or loss since the investment has not yet been sold and there are no cash processed yet. Second, equity method. For investments that involve 20% or more of the issuing corporation's outstanding stock, there is no adjustment to fair value. 5. Sell the stock investment. First, fair value through net income method. A final difference between the two methods is on the sale of the investment. The carrying value of the investment under the fair value through net income method must be adjusted to fair value at the time the shares are sold. The investment account is debit if the fair value increase and an unrealized gain is recognized by crediting the unrealized holding gain or loss net income account. This account in the journal entry are reversed if the fair value of the investment declines. Second, equity method. For investment that use the equity method, there is no adjustment to fair value at the time of sale. Hi, thank you for watching and learning with me. Hopefully this will be useful for you and increase your knowledge about what equity securities are. Thank you and see you.